Welcome to the first episode of Talk Loans and Life with me. I'm Donna Walker, your host, and I'm here with my son, Max, and he's going to ask me some questions today about loans and life. Max, take it away.
First question. What is the top 3 biggest mistake first-time home buyers make?
Max, the biggest mistake people make is not having their funding lined up and pre-approved before they go out to look at that first house. You want to know what you can afford so your expectations are set.
Yeah.
So you want to look within your price range and you want to understand that what you can afford, the maximum amount you can afford, isn't necessarily what you should spend, because it's not just the price of the home, it's the property taxes.
Yeah.
Those are due twice a year. It's the mortgage insurance if you're putting less than 20% down. And that's the mortgage insurance that protects the bank. Then additionally, you need homeowner's insurance.
Yeah.
And then you might have an HOA. And sometimes those can be hundreds of dollars a month. They might, take care of the common areas, plowing, doing lawn mowing, etc. So you always want to know all the costs.
Yeah.
That's the second mistake. Third biggest mistake people make when they're buying a home, first time or any other time, is not using me as a lender. It just is.
It is.
It is.
Was that the third one?
That's the third.
Oh.
Actually, it should be number one, if I'm being honest.
So why do you feel like one of the biggest mistakes is people choosing another lender over you? Like, what makes you stand out compared to other lenders?
What makes me stand out?
asking you what makes you
it's
stand
not my
out.
height, for sure.
Okay.
I don't stand out for that.
Yeah.
What makes me stand out is that I base my business on transparency.
Yeah, that's big.
So I believe that you should know where every dollar that you're spending goes. I have a heart for making sure every question is answered, and it's answered in a way that can be understood. Mm-hmm. I think that there's nothing more frustrating when you're making a large purchase, especially, is you're operating in a world that you're not really familiar with, right? Because your average person doesn't know what a basis point is and some other fancy mortgage lingo, but it can be explained in a way that makes it easy to understand and also gives you the opportunity to know exactly what you're agreeing to.
Yeah. Very true. Transparency is key.
Transparency
is key.
That's key. I always say, put my numbers in AI.
Yeah.
Ask it to find anything in there that's fluff or that is sus.
Right.
Anyway, you get what I'm saying. Any time, and not just me, but you should expect that from any lender and any situation.
Yeah.
Because I bought a car in August, and I know I paid that salesperson, and that's fine. I expect people to get paid for when they, for working.
Yeah.
Everybody gets paid.
Yeah.
But I would have liked to have known what I paid.
Yeah.
In commission or in addition to what the car costs.
Yeah.
So transparency is key. Always expect that.
Question number 2. As a young guy, these are the kind of questions I want the answers to. So how much money do you actually need to buy a house?
Good question.
This is my question.
You're probably thinking, I'll buy my own house someday.
I do.
So, how much money do you need? Well, how much do you think you need? I mean, honestly, when you think about buying a house, what kind of numbers pop into your head?
When I think of buying a house, I think of When I think of buying a house, I think you need... I don't want to sound dumb.
No, you're not going to sound dumb because, you don't know.
Like $50,000.
Okay. That's fair
for down.
50 down?
I mean, not 50 down, but maybe just 50 all included. You got to be willing to have 50 ready to go into the house.
Ready to just throw in the house.
Yeah.
Okay. That's fair.
Okay.
That's a fair, I would have said maybe when I was your age, maybe I would have thought $100,000.
Yeah.
You don't know. It just seems like a big, almost insurmountable thing to achieve. But here's the cool thing, is you need 3% down on a conventional mortgage. A conventional mortgage is a mortgage where your credit score is hovering 680 or above.
What?
Generally. These are all subject to loan approval and all the other, disclosures. So backing that up, if you're an FHA loan, you can go down to 500 on a credit score. Because when you're starting out, you're just building your credit, you don't know what your credit score is.
Yeah.
So 3% conventional, 3.5% FHA. You're going to have, when you put less than 20% down, you'll have private mortgage insurance. But so just say $300,000 house.
Okay.
You need $10,000 for a down payment. But say you have 25. Should you put all 25 in?
No.
No, you shouldn't. You should put that minimum amount. I always say a minimum out of pocket.
Okay.
Okay, so here's the hack. You go in with your 3% down. You find a house that has sellers that are willing to pay for your closing costs. Because it's not just the down payment, it's the closing cost. 3 to 5% is going to closing costs, prepaids.
What are prepaids?
So prepaids, I'm glad you asked, because prepaids, when you close on a home, you're paying 1 year of homeowner's insurance up front.
Yeah.
That lender wants to know that if that house burns to the ground, God forbid, you're insured. You got that first year paid up front. And then the closing costs also cover, title insurance, homeowner taxes, all the fees, documents. You should figure about 3 to 5%. So just say you put 10,000 in, you have 15,000 left in the bank. You should leave it in the bank. You have to have emergency funds when you have a home. There's going to be expenses when you move into a house. I'd say if you want to buy a $300,000 house, you need $10,000 and willing sellers.
Is it hard to find sellers who will pay the closing costs?
That's a good question. And the answer depends on your real estate agent.
Okay.
And the market. So like 2020, you ain't gonna find anybody to pay anything for anybody. Everybody's paying over and above and then some. So houses that have been on the market longer than 2 weeks, 3 weeks, then you're gonna have a better chance of having motivated sellers to pay closing costs. You just have to find the right sellers, But you know what? If you don't have a real estate agent that's willing to fight for you and is gonna negotiate, then you're out of luck.
You're SOL?
You're SOL. Yeah, and there's like certain loans, FHA has a different amount you can contribute, so sellers can't contribute as much on FHA.
Is it hard to find a seller who will pay those closing costs?
It is not hard. You have to have a real estate agent that's willing to negotiate for you. So they're out there.
Okay.
I've seen them. They exist.
Okay. Question number 3. Mom,
Max.
Dia Diva, what is the difference between getting pre-qualified and getting pre-approved?
That's one of my favorite questions.
Okay. I'm glad I asked.
I'm so glad you asked that too. Pre-qualified means, based on what you told me, Max, you qualify for X amount of dollars.
Okay.
That's like, you call me up on a Saturday, you're like, hey, Donna, Mom, I want to find this house. I want to buy this house for $400,000. Right now I'm making $100,000 a month and I got no debt and my credit score is 900, which isn't even possible. And then I say, based on what you told me, you qualify.
Yeah.
And you're like, sweet. And then I can write you a pre-qualification letter, but most real estate agents, most sellers are not going to accept that. They're going to want to accept a pre-approval letter.
What?
And the difference is that when you get a pre-approval letter, first of all, you know that when you write an offer with a pre-qualified letter, don't mean nothing.
Don't mean nothing.
Don't mean nothing.
Nothing.
But if you come in with a pre-approval letter from me or from any reputable lender, and no, I'm not gonna throw any shade on any companies.
Yeah.
But if you're a .com, you're not as credible. So if you have a pre-qualified, it's just hot air. It's just basically whatever you told me. You could be exaggerating.
Yeah.
People often think their credit scores are what Experian shows, and they're oftentimes not that high. But a pre-approval letter means that somebody like myself has taken down an application, has run your credit, has looked at your income docs, not just, based on what you've said.
Yeah.
But I've gone through your file and I've pre-underwritten your file and I've said, based on all the knowledge that I can gather that I'm going to send into underwriting officially, you qualify and you're approved. You know, it's not a final approval. That doesn't come until later in the process after a purchase agreement's written. But yeah.
So the pre-approval just has more steps to it. It's like more solidified.
Pre-approval is key. I mean, that means, you know, you're vetted. You've been, you know, kind of run through the background.
Yeah.
And also, you should also expect for your lender, whether it be me or anyone else, when you do submit an offer, at least I do this.
Yeah.
When someone submits an offer that's a client of mine, I call the selling agent and I say, I'm Donna Walker, and I just want to call on behalf of my client that let you know that I know this client personally. I've personally underwritten the file. This is, you know, an eligible buyer. And twice has made the difference in the person getting the deal in a multiple offer situation.
Wow.
That feels good.
It's pretty awesome.
Yeah, it is pretty awesome. Actually, in one case, my client had been turned down. And when I called, the real estate agent was like, you know what, I'm going to call my sellers back and tell them I think that they should take your offer or your client's offer.
So you like saved the situation?
I totally did. I should have gotten a cape for that. It was like save the day. It was a great feeling.
I was going to make a super lender joke because it was super lit. Never mind.
The super lit.
No. Next question. What credit score do you realistically need to be able to buy a home?
You need at least a 500 credit score.
At least?
At least.
Okay.
It's better, the higher, obviously, that your credit is, the better rate you're going to get, the more options you're going to have. However, now there's two kinds of credit scores. There's Vantage credit score and there's a FICO. FICO is based on your longevity, you know, like I'm older, so I've been with my creditors for longer. So I would go with FICO, but somebody maybe that was younger, like yourself, maybe Vantage. I know you're in a different situation because I've added you to my credit card when you were 14 or 15.
Yeah.
So that helps you have a high credit score. But if that wasn't the case for somebody, you could use your Vantage score, which kind of takes into consideration, say you've been renting and you paid your utilities on time, you paid your rent on time. Vantage score takes those things into consideration, like real life practical things.
Yeah. Oh, wait.
And not all lenders will do that, but I have many.
Question number 5. When buying a house, do you have to put 20% down, or is that just a myth?
That's a myth.
It's a myth?
That's a myth.
Myth busted.
Busted.
Myth busted.
Busted.
Because I know we kind of touched on it earlier, but briefly, why is having 20% down a myth? Like, why do you not need that?
I mean, it's not a myth. You don't, I mean, yes, it's a myth. You don't need it.
Yeah.
Back in the day, you did. But now it's 3%. I mean, a lot of people don't know that. If you're VA eligible or if you buy a USDA property, which is a rural property, you can put 0 down.
How does that work?
That's that type of loan it is. A VA veterans loan requires 0% down, and a USDA loan in a rural area. There is a website where you can check the address of a property to see if it qualifies for USDA. It's an incentivizing rural development.
Yeah.
So 0% down. So 0 to 3%, 5%. I mean, you can go anywhere. You can go up to 50. You can go up to 75% down.
You can do 100%.
Once you can just pay cash.
You could.
But once you get to 20%, you have no more private mortgage insurance. You've got enough skin in the game that the bank's like, okay, we'll drop that. And here's an important distinction. There's FHA loans, which require a 3.5% down payment. Then there's conventional loans, which is 3% at the lowest.
All right.
Now, this is super important. If you have an FHA loan, you have PMI, which is private mortgage insurance for the life of that loan.
All right.
So if it's 30 years, you're paying PMI for 30 years. No bueno. So you want to make sure if you have an FHA loan that you refinance when you have 20% equity in your home.
All right.
That will get rid of that PMI. However, if you have a conventional loan, Once you have 20% equity, and that's determined by an appraisal, you can just call a bank, lender, whoever's servicing your loan, and just say, hey, I'm at 20% equity. I want you to remove the PMI, and they got to do that.
All right. They have to?
They do.
They got to do it.
They got to do it. So I want to tell you my story. I had
For this one?
This is a true story.
All right.
Ties in. I had these clients, and they were, very savvy and very financially sound. Mm-hmm. They chose to put 5% down on a conventional loan, and they were kind of toying back and forth, like, do I want to pay the private mortgage insurance and only put 5% down, or do and keep my money in the bank? And I always advise that, you do obviously what's most comfortable for you financially. But if someone asks me what I would do, I would put as little out of pocket as possible.
Boy.
And because you can always pay down your principal. But especially first home. So this is a first-time home buyer, first-time investor. So they found a property that was a triplex, and they chose to go the 5% route, knowing that they would be able to get that private mortgage insurance off when they had 20% equity. Then the appraisal comes back $50,000 over what they were paying.
Whoa.
And you cannot raise the price of the house after, at that point. So they went into it almost at that 20% equity. So with just 5% down. So
that's pretty cool.
That was a super big win. That was one of my favorites.
I have no idea what that means, but it was cool.
Well, and also, wait, I'm not done. They had tenants in the 2 units that paid the entire mortgage. So they lived in their unit rent-free, and they had other people paying down their appreciating asset. And that's called a house hack.
Yeah.
I highly recommend it for anyone that can do that.
Hashtag house
hack.
Question number 6. What is the biggest hidden cost that people don't budget for when they're buying a house?
Pets.
Okay, well.
Sorry, I was just looking at my cat.
We don't have a cat in the studio.
We don't have a cat in the
studio.
No. Okay, biggest hidden costs? There's a lot. Property taxes can vary by zip code. So we're talking like one street over, you could pay $7,000 a year in taxes versus $3,000 a year in taxes. So that's a big, huge difference.
Yeah.
That's very important. You can look up an address. The tax records are online, so you can, and your realtor, your lender should have that information readily available to you, so you don't have to do a lot of that digging yourself. Another large hidden cost is your homeowner's insurance.
Okay.
You got to shop that around, and even if you escrow, you got to shop your homeowner's insurance every year.
What is an escrow?
Escrow is an account where you prepay homeowner's insurance and taxes. So the bank does that for you. They include it in your payment. So you can have principal and interest only and pay your taxes and insurance yourself. Or some people are like, I don't want to mess with that. I just want everything in one payment, like one-stop shop. So it's PITI. Which is?
What's PITI?
Principal, interest, taxes, and insurance.
Okay.
And that is when they're taking it in advance and they're saving it in a special escrow account. And they pay those taxes and insurance for you. I personally don't prefer to do that. I prefer to have a clean principal and interest. It just it's not always available. Mm-hmm. Some lenders will not do that without penalizing you with a higher interest rate. It just depends. But if you can do it, I always recommend doing that. Having that control over your own finances as much as possible.
Next question, number 7. What is the one thing you should never, never, ever do after you apply for a mortgage?
Okay, there's a few things. Never change jobs mid-mortgage process. Deal breaker. Most likely, you're SOL. Never open a new credit card. Do not go finance furniture for your new home. And don't make a large cash deposit that you can't source.
Those.
You can get a gift towards your down payment, towards at closing. You can get a gift. They can send a gift letter. Your relative is not going to want to probably open their bank account, records to you. So That's fine. If so if you have a generous parent that's going to give you $100,000, then you want to wait for them to give you that $100,000 and have them give it to you at the closing table.
Okay.
Because if they give you $100,000, even if it's a sourceable deposit, that source has to then be sourced. So then your generous mother, generous father, aunt, uncle, whoever gave you the money, they have to go and provide their bank statements, and that does not make relatives happy.
Yeah.
That's not.
It's just extra steps, not really.
And people don't want to give out their bank statements for giving a gift to somebody.
True.
Just sit on your hands after you apply for a mortgage.
And just wait.
Literally, just wait.
Okay.
Wait until you're at the closing table. When you sign on the dotted line, go do whatever you want to do.
Okay. But until then?
Till then, do not.
Okay. Next question, number 8. When should someone refinance? And also, when does refinancing not really make sense for someone? 2-part question.
Okay. So you should refinance if you want to get money, like cash out of your house. You should do a cash out refinance. Or if you're going to lower your monthly payment and you're going to be able to recoup your costs within 3 years. Otherwise, you're just making somebody money.
Yeah.
And it's not you.
Yeah.
But say, you have had that generous relative that gave you $100,000 and you moved into your home and you were like, I really want a pool. You could go refinance their house, take the cash out of that's your equity. I think someone's at the door.
It's our huge cat.
It's our huge cat that's locked up. So you should only refinance if you're going to be able to recoup the cost of the refinance within 3 years. And also, because a really important thing about refinancing is your clock starts over.
Yeah.
So, but fun story, everybody loves a fun story. This is a true story also. I had a client that came to me wanting to cash out, refi their investment property, which I do that. But looking at their financials, it made more sense to take the cash out of their home because you're always going to get a lower interest rate on a residential property. They had their primary mortgage, they had a HELOC, which seems like a great idea when you have the line of credit to pull out your equity, but it's it's a variable rate. So the HELOC payment was almost as much as their first mortgage payment. So, and then their homeowner's insurance was $12,000 a month.
12,000?
A month. I mean, a year. But still.
12,000 a year. So bad.
I was like, oh my goodness.
Yeah.
What we determined was that it was escrowed, PITI, and just like myself when I was a first-time home buyer, I didn't know that you could shop your homeowner's insurance. No one disclosed that to me. I didn't understand that 25 years ago. So my homeowners had gotten high, not quite that high, but I mean, they had a lot larger home and, on the river and all the things. So what's important about when you're refinancing is like, if you have a 30-year mortgage and you're 25, you refinance, you're starting that 30 years over again.
Yeah.
And that's no bueno because that's Spanish for no good.
Yeah.
I'm bilingual.
Partially. That's 2 years of Spanish, 2 years of Italian, and 2 years of Latin. There you go. So what I was getting at is, so this client that we just closed not long ago, we were able to take them to a 15-year from a 20. So it didn't set the clock back. It actually kept it where it was. They were 5 years into their mortgage anyway. Kept it, kept the timeline steady at 15 years. You always, if you can, you want to refinance into a lower, number of years. Yeah.
Unless you just don't give a rip-roaring rip, then you can do whatever you want.
Yeah.
Just don't go for the quick fix.
Does that also answer the question, when should someone not refinance?
When you you should not refinance when someone comes up to you and is like, hey, Max, I know you just got a loan last year, but you want to refinance? Save you 0.25%?
No.
No.
That's when you don't want to?
Yeah.
When the sleazy guy comes in?
When someone comes to you and asks you if you want to refinance your loan, ask them why you should.
And if they can't give you a cost savings analysis that makes sense, and ethically, it's not a fiduciary. It's not as a mortgage lender, I have a fiduciary responsibility to my clients to make decisions and advise in a way that is financially sound and makes sense for them and is advantageous. If you can't recoup your costs in 3 years, it's not a good decision. Unless you need the cash out. You want to put a pool in, then it's worth it. And you can have us over for a pool party.
All right. You ready? This is a big one.
Okay. Pink.
Because this one's to me.
Pink.
What?
What's my favorite color?
Pink?
Oh, is that what you're asking?
Oh, no.
Oh, okay.
Last question, though. If you could give advice to a future home buyer.
For money.
Well, that's the next question. If you could give advice to a future home buyer, so me, for example.
Okay.
What is the advice that you would give to them?
Okay. I would say to you, I'm saying to you.
Okay.
Do not assume that you should rent versus buying.
There are some rent questions there, so rent may be a controversial topic. If you should rent, if you should just put that money into a house.
Okay, so a lot of people assume that they can't buy a home, that they have to rent.
Yeah.
My advice to you is never assume you can't own a home.
Okay.
That you have to rent first. That's massive, massive myth. There are some people paying rent right now that far exceeds what a home payment would be, even with the PITI.
Oh, yeah.
So always, always, always investigate and look at all your options. Bonus piece of advice, stop going to Starbucks.
Okay. Is it just Starbucks or are you
It's
talking
not
about
against Starbucks. I'm just saying, like,
money?
if you have $8 that you're drinking a day, I'm just saying be wise with your money at a young age so that because the money that you spend on little things, that's where it leaks, right? And then if you pull those bank records and you look back at it, it hurts.
Yeah.
Because you think about, if you put $5,000 in the bank right now and you invested $5,000 and you didn't touch it until you're 50, you could be a multimillionaire.
Yeah.
No, for real. You could.
Like for real?
For real. I'm serious.
Yeah, I believe you.
So how many Starbucks is that? Like 50?
Yeah.
So give up 50 Starbucks, 50 trips to Caribou, 50 trips to Culver's, even though shout out, you get a lot of compliments when you go through the drive-thru. But seriously, my biggest piece of advice to you as my darling son, my favorite middle child, my favorite oldest child is behind the camera, my favorite youngest child is at soccer, and my favorite daughter, shopping, of course. No, but really, my answer to your question, Max, is a good question. And first of all, very wise to ask questions. That's my first piece of advice is keep asking questions.
Okay.
My second piece of advice is never assume you can't own a home.
Okay.
Never assume that you need to rent for a certain number of years. Even if you move out of your home with your parents into your first home that you purchased, you don't have to have a rental history.
Now let's just talk loans in life.
Yeah, it is.
And I haven't really asked a life question yet.
Okay, ask me.
No, wait. In the grand scheme of life, if you were my age, 19, what is a piece of advice you would give to your 19-year-old self?
Oh, if I could go back to 19
Yeah.
and tell myself something, so I'll tell you. I'll tell you because I can't do that. Because I'm not 19. Invest a small amount of money and don't touch it.
Okay.
And it'll grow exponentially to where when you're 40, 45, 50, you'll have financial freedom that you never would have dreamt that small amount of money could grow to.
Okay.
So that's my advice.
That's an amazing piece of advice.
It is an amazing piece of advice. Also, like, it doesn't have to be like thousands and hundreds of thousands of dollars. All it has to be, take a chunk of money, you get a graduation, you get money for graduation, invest it in stocks.
Okay.
And then don't touch it. Here's one more thing I want to ask you.
Now I'm getting questioned.
We're going to talk about losing life with Max.
Oh, he's leaning on the plan.
If you could go back in time and choose again, would you have 3 cats and a dog?
No.
That's not a good.
Because, okay, he's scared.
Oh, I hurt his feelings. Okay, my last question. Should we dab it out?
This has been the first episode of Talk Loans in Life.
Out.
Should I do that? What's the difference between getting pre-qualified and pre-approved?
Yes.
Okay. All right, the next one is what credit score do you realistically need to buy a home?
What? I was dancing. What do you need credit score wise?
What credit score do you realistically need to buy a home?
You can have.
Well, I'm asking you again.
Hey.
What? Next question. Oh yeah. You want to tell me shortly? Because I think we kind of like touched on this earlier.
Why'd you say
but
shortly and look at me?
what? I didn't. I looked at it. Like just quickly.
You don't just say short.
I didn't say short.
You said short when you looked at me. But that's okay.
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 Say it again.
Okay.
Okay.
Short. You said
So I
short.
know we kind of covered this a little bit ago, but briefly,
I was just
why?
joking about the short thing. That's fine.
What?
You can say short.
I know.
I know I'm short. Short stack.
I didn't even look at you when I said.
Oh yeah! Got that.
How much house can you truly afford without becoming house poor? Or was that? What? Anyone else see that? All right. Question number 6.
Let me get my video. Okay. This is my assistant.
Okay.
I mean, please, right?
Please.
Um.
Oh, no, I gotta ask it again.
Dun dun dun.
Talk loans with me. Talk loans with me.